Lesson 7. Working Capital and Optimal Machine Replacement. This lesson covers two major topics that refine the investment analysis introduced in earlier lessons. The first topic is working capital, how the timing of payments to suppliers and receipts from customers creates an additional cash flow dimension. The second topic is optimal replacement timing, a method for deciding when to replace a machine using the annual equivalent value criterion. Part 1. Working Capital in Investment Decisions. 1. What is working capital? Working capital is defined as current assets minus current liabilities. In project evaluation, the most important components are accounts receivable, money owed to the firm by its customers, and accounts payable, money the firm owes to its suppliers. Working capital matters because it affects the timing of actual cash flows. A project that appears profitable on paper may tie up large amounts of cash in working capital, reducing its true NPV. Conversely, a business model with negative working capital effectively receives free financing, which improves NPV. 2. Computing accounts receivable and accounts payable. Accounts receivable for a given year equals sales multiplied by the customer credit percentage. For instance, if annual sales are 400,000 shekels and the firm grants customers credit equal to 45% of annual sales, accounts receivable equals 180,000 shekels. This means that amount of revenue is stuck, recorded but not yet collected as cash. Accounts payable works symmetrically. If annual purchases are 250,000 shekels and the firm receives supplier credit equal to 30%, accounts payable equals 75,000 shekels. This means the firm has deferred paying 75,000 shekels, effectively receiving short-term financing. 3. Net working capital and the six-step method. Net working capital equals accounts receivable minus accounts payable. The course presents a systematic six-step procedure. Step 1. Compute accounts receivable for each year. Step 2. Compute accounts payable for each year. Step 3. Compute the difference, receivables minus payables, to get annual working capital. Step 4. Record the payments that will be received with a delay equal to the credit period. Step 5. Compute net credit, the result of Step 3 minus Step 4, which represents the investment in working capital. Step 6. Net working capital for cash flow purposes is the negative of Step 5. 4. Integrating working capital into NPV. When computing a project's NPV, working capital investment must appear in the cash flow timeline. At the start of the project, the initial working capital investment is a negative cash flow. In subsequent years, the change in working capital is subtracted from operating cash flows. Crucially, at the end of the project, all accumulated working capital is released back as a positive cash flow. Customers pay their final bills, and there are no more supplier obligations. 5. The travel company insight. A travel company collects payment from customers before their trip but pays suppliers after the trip. This creates negative working capital. The company is effectively financed by its customers. Negative working capital improves the project's NPV because cash comes in before it goes out. Part 2. Optimal machine replacement timing. 6. The replacement problem. Many businesses face the question of when to replace a depreciating asset. As a machine ages, maintenance costs rise and resale value falls, but buying a new machine requires a large upfront investment. The challenge is that different replacement cycles have different lifespans, making their NPVs not directly comparable. 7. The AEV method, annual equivalent value. The solution is to convert each option's NPV into an equivalent annual payment using the AEV method. AEV is computed as the payment of the NPV over n years at the cost of capital R. The decision rule: choose the replacement cycle with the highest AEV. If the analysis involves only costs, choose the cycle with the lowest annual equivalent cost. 8. Truck replacement example. A company purchases a truck for 600,000 shekels. 5 options are evaluated, replacing every 1, 2, 3, 4, or 5 years. Step 1. Compute NPV for each single cycle option, including the initial cost, annual operating cash flows, and the resale value at the end. Step 2. For each option, compute AEV using the payment formula. Step 3. Compare AEV values across all 5 options and select the one with the highest AEV. This is the optimal replacement frequency. 9. Why AEV is necessary. AEV works because it normalizes the NPV to a per-year basis. A short cycle that is repeated many times is placed on equal footing with a long cycle. Think of it as finding a common denominator. AEV converts every option into the same unit value per year, so they can be compared fairly. 10. Special case, cost-only analysis. Sometimes the replacement decision involves an asset that does not generate revenue directly, like a company car. In this case, all cash flows are negative. The optimal choice is the one with the least negative AEV, meaning the lowest annual equivalent cost. Summary: working capital adds a layer of realism to project evaluation. The credit terms create timing differences between accounting entries and actual cash flows. These must be captured in the NPV calculation. At project end, accumulated working capital is released. Optimal replacement timing addresses the comparison of alternatives with unequal lifespans. The AEV method converts each option's NPV into an equivalent annual value, enabling fair comparison. The steps are: compute NPV for a single cycle, compute AEV, and select the option with the highest AEV or lowest annual cost.